Hello, thank you for attending, everyone. Welcome back to another video presentation. My name is Seewing Yee from the Yee Real Estate Network, and today's topic is an update on the Cape Coral, Southwest Florida market. And before I reintroduce Justin Zawodny again, Justin and his team, they is a one-stop shop, total one-stop shop. He does property management. He does all the hand holding, not just short term and long term. One thing, I do not want to embarrass him, but I have done a recent survey of my database of several thousand members. And no surprise to me, Justin Zawodny is rated #1 among our investors that purchase out of state properties. As you guys know, I have many markets I'm representing, around 6 markets in the country. So clearly, there's a reason why Justin has ranked #1 in customer satisfaction, because he cares about our investors, our clients. He care he just put himself in the shoes of an out-of-state investor, understand the goals and concerns and challenges involved, and he take his time and educate and inform our investors every step from beginning to the end, the whole 9 yards. And he does everything. He go out of his way to do what's best to the best interest of our investors, whatever it is, anything, rehab, taking care of issues, minor, major. He's one of those things. It's just Justin, it's a pleasure working with you, and we'll continue to do it for a long time. So with that said, Justin, he market his region for our investors in pretty vast. Southwest Florida is quite large, actually. So, I mean, he not only he does Cape Coral, he does the suburban areas, like LaBelle, Lehigh Acres, even Port Charlotte, Northport, up there, up to the north, within a 100-mile radius. So, Justin covers a very large, vast area, great opportunities. Our investors have done very well in terms of cash flow, appreciation, the whole 9 yards. So I'm couldn't be happier. So before Justin begin his presentation, I like to give you this 3 heads up, okay? And please, you guys out there, remember these 3 things I'm going to say before Justin start. #1, get ahead of the curve. I say it again, get ahead of the curve. #2, focus on the path of growth. And #3 is suburban inland migration. All right, with that said, Justin have a very good agenda, so pay attention because you're gonna love it. He's going to debunk the negativity. He's going to give you factual information based on research and due diligence. Is factual, is validated, is confirmed. So because Justin, he knows his market. All right, he may look young, he's a younger millennial, but he's wise beyond his years. Okay, enough of this warm and fuzzy feeling. So Justin, I know you're embarrassed, go ahead, do your presentation. Yeah. I don't want to distract you.
Thanks, Mr. Yee. And yeah, I mean, I want to just touch on a couple key points today. I don't want to make it too much for anybody, but first and foremost, I mean, want to come on and just talk a little bit about the portfolio and how the homes handled the storm that hit our area pretty severely last month. Really, this storm is a true test for the quality of the homes, right? It was the worst storm to hit Southwest Florida in 90 years. The closest storm they could compare it to for the Cape Coral market was back in 1930. Even comparing it to some of the more recent storms like Hurricane Charlie, which hit back in 2004, it was just significantly worse, right? Hurricane Charlie, the radius of the hurricane force winds, the strongest winds of the storm was 35 miles. This storm that hit, the eye of the storm was 30 miles wide. Almost the entire hurricane wind radius of Charlie could fit inside the eye of this storm. I mean, it was incredible how big and strong this storm was. But even through all of that, the average repair that we're looking at in Cape Coral for the homes, it's really just patching roofs. We had very, very minimal damage. Yes, the trees got knocked over and we had to get those stood up by the landscaper and supported. Not a huge cost there. Yes, we did lose some shingles. We might have had some shutter damage because we had the hurricane shutters up on all of the properties. But in the grand scheme of things, we're at pretty reasonable numbers considering the severity of this storm. The good news is where we positioned our investors, none of the homes flooded, right? The flooding was the biggest cause of a lot of the damage that you're seeing. And they did overall really, really well. But one of the key points now to look at is how this has shaped our market. The storm, it destroyed thousands of homes, primarily on the beaches. So Sanibel, Captiva, Fort Myers Beach, even down into Bonita and Naples. Those homes directly on the beaches are the ones where you're probably seeing a lot of pictures on the news of the severe damage. Where we were positioned in Cape Coral, we were okay. There was damage, but it wasn't total loss like what you're seeing in some of the other areas. But that being said, when you lose thousands of homes, it puts thousands of people into either the purchasing or rental market and removes a lot of inventory. So the biggest driving force for better part of 3 years now with this boom that we've seen has been the issues where we see such high demand and such small inventory. And the storm didn't do that any favors. It just increased that problem. It put even more demand out there and even less supply out there. So it's certainly, the rental market in particular has been pretty crazy. We have several investors in the network who put homes up for rent and we had them leased in a matter of hours, in some cases, incredibly fast. Which is always good to see. It's going to help maximize those investments. So again, really, really good there as far as what we saw through one of the worst, natural catastrophes this area has seen ever. So all good there. Another thing, that's also, again, going back to that supply and demand, which is the driving force of our market right now, are the interest rates. As interest rates continue to rise, it's truthfully not slowing demand the way you would expect it to, right? Part of the benefit of the homes that we're selecting, and these are homes that your everyday, your everyday nurse, your everyday, plumber, electrician can afford, right? So we're not seeing, in the end, someone has to live somewhere. So if people need a place to live, these are the homes they're selecting. So the demand is still overwhelming. The builders cannot keep up with it, even with the rising interest rates. However, one adverse effect of the rising interest rates is it's limiting how much the builders can build, right? A lot of builders are going to use a construction loan to build a home. They borrow the money from the bank. They pay them a origination fee and interest, just like a mortgage, just on a much shorter term, to build the house. If the interest rate continues to get higher and higher and higher, they have the less and less ability to borrow the money to build more. But if demand's not slowing, it's just making that gap between the supply and the demand even larger. So again, good for our market in the sense that it's showing the strength that even through all of these different forces that could damage it, it's still moving forward and prices are still rising. And even we saw a $5,000 increase over the last 30 days from the builder that we work the most with in Cape Coral. Their 4-bedroom home, it went up to $405 at this point. Their 3-bedroom home is up to $395. So still rising prices and still selling incredibly quickly. When we get inventory lists, it's gone within a matter of a week or so, and there's a whole new inventory list coming out. So moving very, very quickly, which is great to see. It really does show the health of the market if it can go through these turbulent times and continue to grow and continue to increase in value. It's really good.
Yeah, before you go on, Justin, before you go on, let me say one quick thing. Nationwide is going to be a record low supply again, because homeowners, they are not selling their home. Why should they sell their home when they have massive amount of equity and they are locked in at a 4% interest rate or lower? If they were to sell, they have to upgrade and buy upgrade a home, which will cost more. And with the 7% interest rate, they have to double their mortgage payment. So resellers are not sellers are not selling. Builders are pausing inventory, like you just said. The ripple effect of this is where to project. People doesn't understand the ripple effect of this low supply. I mean, not just it's occurring right now, but in the next few years, we will see the pain of extreme low supply from builders not constructing and sellers are not selling. So it's going to be better for investors now to lock it in and ride the wave of good things going on.
I mean, another factor too for our market, again, supply chain has been a huge issue for several years now. One of the biggest limiting factors right now, one of the hardest materials to get their hands on is drywall, right? I've heard, and whether this is true or not, I've heard of some builders who are purchasing drywall as far as Arizona and shipping it across the country to get it here so they can continue building homes because their suppliers here cannot get them drywall quick enough. Well, now not only do we have all the new construction, which was using a majority of this drywall, but now we have thousands of homes that just recently flooded that had to rip the drywall out of the homes because it was soaked, who now need to replace it. So to think that we're going to catch up with the inventory that we need is very unlikely. We're still going to see that supply very, very limited just because there's only so many materials they can use to build the homes.
So the cost of construction, Justin, the cost of constructions to rebuild your region, the builder going to raise those prices. Because if the builders are going to raise those prices, the value and cost of the homes will go up in a foreseeable future. So investors that are smart, that take advantage of today's opportunity, will ride those value of going up. So that's
and again, the one thing a lot of investors are very concerned about with the interest rate, and I fully understand it. It's not ideal. No one wants to take out a loan with a 7.5% interest rate.
Right.
In under normal circumstances, they're right. It's not great. However, we have homes here that are in positive cash flow, even with a 7.5% interest rate. We're in positive cash flow. So let's think 2 years into the future now, right? Let's say that we have investor A and investor B. So investor A, they said, let's do it. Let's buy the home. We'll buy it with a 7.5% interest rate. I'll buy that 4-bedroom home at a $400,000 purchase price and have positive cash flow. I know it's not much, but there's positive cash flow. And now we have investor B. And investor B says, you know what? That's too high of an interest rate for me. I'm going to wait. I'll buy it later once that interest rate drops, right? So I fast forward 2-3 years down the road, right? And our interest rates are now back down to even, let's say, a 5 or a 5.5, just a small, drop, not to the historic lows, but just a reasonable drop. Well, now investor A can go refinance their loan. They don't need to take any money out, right? So their balance on their mortgage isn't getting any bigger. The only thing that's going to happen is their payment goes down. So they just increased their cash flow. They locked in their purchase price, and they're going to increase their rent over that time too. So their cash flow at that point, we would expect it to be several $100s a month.
One more thing before I have to interrupt you, because this is so important. Meanwhile, the investor A, the purchase now, even though they have a lower cash flow than we want, you know what the investor A is getting, they are getting equity growth because they buy real estate and wait instead of investment B, they wait to buy real estate more. Also, the renter gonna pay down the mortgage. The renter gonna pay all your monthly debt service for you. Not only the mortgage, the taxes, the property insurance, the property management fee of 8%, and even 5% vacancy and 5% maintenance factor. And then the investor owner at the end of the month still have leftover money for cash flow. Yes. I mean, you get it, lower down payment, principal reduction, equity growth, the renter pay down the mortgage. Is a real estate income property is a multi-dimensional asset. Oh, one more, tax benefit. So real estate is a multi-dimensional asset class, which will beat any other asset class on a historical basis. So okay, go on. I'm so sorry. I have to get this in. I have to get it.
So investor A is in really good shape, right? Yes, their cash flow might have only been, even let's say it was $1,200 over 2 years. It wasn't great, but they had all the other benefits that you just listed. And now when they refinance the loan, their cash flow is going to be probably, guessing, I haven't run the numbers, but I have to assume $300, $400, $500 a month in cash flow at that point, between the increased rent and the decreased mortgage payment. So they're doing really good. Now we look over to investor B. Well, interest rates have dropped. So now we've entered, more buyers into the market. We might see some more resales, some more people who are now, we're renting, waiting, and now they're ready to buy. Well, at this point, now we're going to see prices increase, right? Your buying power just got better, right? So now I can go spend, if I was going to spend, let's say $2,000 a month on a mortgage, well, that $2,000 a month doesn't buy me, a $400,000 home. It's buying me a $500,000 home. I get to go buy more, right? And so we see prices go up. So now we lost out on that equity for investor B. And now when we buy, we might start out, instead of, the $50 to $100 a month in cash flow, we might start out with $150 a month cash flow, but we lost out on all of that equity gain, which is, we're talking about potentially, I don't know, it could come out to be $500 to $1,000 a month, if not more, depending on where those prices go when the rates start dropping. The whole concept behind driving interest rates up, right? The whole concept that they're trying to run with is, well, if we make the money more expensive, people will spend less. We can slow inflation. And once that happens, we can start lowering the rates again, which allows for those normal price increases. We want to capture those price increases in equity so that years from now, when we sell the home, we capture that money as the investor. So again, we're not trying to say this is perfect, right? Because perfect never really exists. But we're still in a very, very good situation for our buyers right now, especially with how much demand there is to rent. It sets us up for our vacancy. Truthfully, most of the homes that have been purchased in the last 2 to 3 months, they're going to be, when we look back on a 3-year period, starting when the home was purchased, they'll likely be under that 5% vacancy. It'd probably be closer to like 2% or so at the most, which just means more return for the investor. So we're in a really good spot right now, which is always good to see. Always ideal. That kind of just leads me into the last thing I wanted to talk about, which is the most important thing an investor can do within your network, even if they're just considering it, even if they're not totally sold that they want to buy right now, even if it's just something they've thought about. The best thing to do is to contact you, Mr. Yee. Once they talk to you, you'll ensure that they are, in fact, in a good spot. They're ready to buy a home here. You'll put them in contact with me. I always have a running list of investors who I know want a home in Southwest Florida, right? Even if they're just considering it, I have them on my list. And I can tell you, especially through times like this, where there's a lot happening outside of just the housing market, right? There's a lot of change happening in a lot of people's lives here in Southwest Florida. When the builder has homes fall out of contracts and come back to them, right? They know the number of buyers that I bring to them. I get one of the first calls saying, "Hey, Justin, we had this home, we had it under contract for 6 months. It's going to be ready in 6 weeks. The buyer fell out. They don't want it. Do you have someone who would scoop it up and buy it in 6 weeks?" And if I can say yes, we typically get these homes for, in some cases, tens of thousands of dollars less than what they're currently being sold for. So now, not only are we buying it with positive cash flow, but we're buying it with instant equity and positive cash flow. And those investors down the road are going to be set up really, really well for a very, very successful long-term investment. The amount of equity they get just from buying it is what we'd expect to see in potentially 2 to 3 years of appreciation. They're getting it just because they're ready to go and they buy it right away. So again, being on that list and being ready when those opportunities come available is, one of the best ways to set yourself up for success with one of these homes.
Yeah, I agree, Justin. Of course, but as you know, I pre-screen my member investors very, very closely before I send to you. Mm-hmm. But if any of our investors, they circumvent me, they go to you directly without consulting with me first. Mm-hmm. You know what you're going to do? You're going to send that investor back.
Get sent back.
Get sent back to me.
Yeah, no, we going through you first is definitely the first step, and make sure that, again, you know a lot of their current situation as well as what they do in other markets far better than me. I might know what an investor is doing here in Southwest Florida, but that's only this much of the picture. You see the whole picture of what they're doing across the country, which is, again, almost like working with a eye patch on. I only see some of the picture.
Yeah, absolutely. Justin, one more thing. You and I know it, but we need to reiterate this one more time. Even with this past storm, Ian, and what have you, people have short memory, but clearly, some unsophisticated investor, they might hear some negative stories about the after effects of the storm, that things are it's going to go crashing in Southwest Florida. They couldn't be further from being wrong, because the job growth and population growth, migration into Florida and into Southwest Florida is not going to change whatsoever.
No. And even beyond that, the speed that Southwest Florida is rebounding at is really pretty incredible to see. We had Sanibel and Captiva Island. They are connected by a bridge. So you come from Fort Myers, go over a bridge, and you end up on Sanibel, which goes up to Captiva. They were completely cut off from the mainland. That bridge was broken in multiple places. They were helicopters going back and forth to get people off of the island for about a week and a half. They were able to get that bridge open in under a month, so that they can start getting the emergency crews back to start getting power and water and getting debris off. It took them about 3.5 weeks. And at this point, I know parts of Captiva and most of Sanibel already had running water to the structures that were still there. And they're getting power back very, very quickly, which is just speeding up how quickly they can rebuild the homes and the businesses in those areas. Another island is Pine Island that goes from Cape Coral. Same thing. They had that temporary bridge up in about 5 to 6 days. They had the bridge open, and they were getting people, debris, services back to the island to speed up that rebuild process. It's not like these are areas that were destroyed or now just being forgotten and left alone. If we go a year into the future, you'll still see some signs of it, in the sense that some buildings will be completely different than they used to be, but they will be fully, livable, fully, functioning businesses, getting back to much more normal,
Yep.
times.
No doubt. Justin, I would like to add this, Justin. You're right, totally right. I heard about that. I've been watching the news and talked to other people about this fast recovery. One more thing, the emergency workers, the recovery workers, they are coming into the region to participate in the recovery of the region. Guess what? These emergency workers, they need places to live, places to rent. And also the people that are displaced, that in the that were living by the water, that are affected by this hurricane, they need places to rent for the next few years temporarily. And guess what? The supply of homes to rent has already been extremely low. Now the rental rates going to increase dramatically all over the region. Who's going to benefit from this new happening? Our investors.
Yeah, we put several homes went on the market about 2 weeks after the storm, and I can tell you, I could not keep up with the phone calls. Honestly, it came down to more of just responding to voicemails. I could not keep up with how quickly the calls were coming in, and all of the calls were people who were displaced. Their home was destroyed by the storm. We had insurance adjusters. Hey, I'm an insurance adjuster from New York, and I have so many clients with homes down there. I'm gonna be stuck down there Monday through Friday for the next year. Do you have anything to rent to me? Oh, hey, we're a licensed insured roofing company from all over the country. We want to be in Cape Coral for the next 2 years repairing roofs, or you name it. The number of people looking for a home was, incredible. And unfortunately, we had enough homes to rent to like 3% of the calls that I was getting, right? We could not rent to everybody. But that's a great situation. It allowed us to be incredibly selective about who, is a highly qualified applicant, got a great rental rate, and, we're able to move very quickly for someone who was in need and get a roof back over their head, which was good to see as well.
And by the way, I say it again, they have money to rent. They have money to rent way above the rate that you've been renting. Imagine that.
Yeah.
A $400,000 property, a single family home, for example, if our investors would buy that, I think the projected rent is like $2,400 right now, give or take. Imagine. I'm not saying it's going to happen, but the chances are, because so many influx of people have money to rent for what we just discussed, we might even get higher than $2,400 monthly rent. Who knows?
Yeah, it's been, it's been just a crazy month, but again, sometimes in real estate, crazy's good, and crazy, as long as it's busy and productive, it's very good. So we've been able to keep our vacancies incredibly low. We've been able to keep all of our tenants and all of our properties, safe, inhabitable, repairing them very, very quickly for what I would consider a very low repair cost, considering what they went through. These roofs that were damaged, we're talking about, 190, 200 mile an hour gusts of wind, and we're only losing, maybe 100-foot section of shingles. That's incredible. The building code did what it was supposed to do, which was important.
Justin, that's why our investors trust you. I trust you, because even before this hurricane came, you placed our investors in the right neighborhood, in the right prices, away from the flood zone, away from the hurricane zone. Our investors are not buying by the beach area. Our investors are buying inland. They're buying new constructions that have hurricane window shutter, that are the construction code by getting a new build. It's just will sustain itself during any future hurricane, which is happening, once in a generation, this hurricane. Furthermore, let me see what else I have to say. Gosh, my train of thought. So I have to assume the insurance cost is a non-factor because you're not. Our investor homes are not in the flood zone. They are not in a hurricane area by the coast. So the insurance cost should remain the same. It's not going to impact cash flow. Some people hear that, the insurance company moving out of Florida, they can't take all these claims, they're going to go bankrupt. That's a little bit of a misconception.
Yeah, I mean, it's the business they're in. I mean, if they didn't set their business up in a way to be prepared for an event like this, that's a poor business model. But I mean, I think one of the things that we will see, especially when starting insurance, I think that there will be a lower age limit on the roof that is allowed. But in this case, we're buying new construction. The roof is brand new. There's not an insurance company that's going to reject insuring your home with a brand new roof that was just constructed. If they're doing that, I mean, they would be. I would assume that the government would step in at that point. That's really just not reasonable in any way. So I wouldn't expect it to become a huge issue for our properties, at least from what I've seen to this point. And really, I mean, the one final thing I wanted to kind of hit on, we've been doing these webinars now for a couple of years, and just kind of, I like to backtrack a little bit. And again, what I tell you now, right? I'm giving you my thoughts on the future. They may or may not be right. We're just kind of using our best estimation based on the trends we're seeing. But if we backtrack a couple of years, I mean, the homes that time, they were below 300,000. The rents at that time were barely pushing, $2,000. We said, no, like, just stick with it. Look what the trends are. Those same homes that those investors bought, we're pushing like a 1% rent to value ratio right now, which is incredibly good for Southwest Florida. It really does not exist if you buy a new home. It's something that happens over time. We're talking about in a short period of 2 years, we've increased that 1% rent to value ratio. We've seen, I mean, $100,000 worth of appreciation. A lot of the trends that we were projecting, they happened even faster than what we were projecting them, but they've certainly continued. So, when we kind of look at these trends, we're not just saying best case scenario. We're looking at what's happening and really trying to be as accurate as possible while being conservative and not over promising either. So, hopefully we can continue, keeping a close eye. And if the trends continue as they are, we're looking to have a really successful market for years and years to come.
No doubt, Justin. Past performance is not an indication of future success because no one can predict the future, what you just said, to your point. But our investors have done so well in the past 3 years. I mean, it's just amazing how much money they made in such a short period of time. But once again, we're gonna be very conservative in our projection. But things in the future looking very, very bright. One more thing, at the beginning I mentioned, get ahead of the curve. Number one. Number two, path of growth. Number three, suburban inland migration. And that is what's happening. Folks out there, Justin, he knows what he's doing. That's what he's doing. These 3 comments I just made, that's exactly what Justin is doing. Suburban, yes, there's still some opportunity in Cape Coral on which discussed, but Justin is smart.
I think LaBelle is certainly a market to keep an eye on, especially if you're an entry level new investor, and you're looking for something a little bit more attainable than that $400,000 house in Cape Coral. LaBelle is certainly an area to look at where we're still under 300,000 for now. I can tell you, looking at their inventory sheet and the homes that are being built early next year, that staying below 300,000 is only going to last so long. They're already, I mean, the homes that are closing next February and March, they're knocking right on that $300,000 door. So it's coming soon where it'll crack through that ceiling and really start growing quickly. So certainly a good opportunity to buy while the prices are good, buy in an area where people are moving to get to more affordable homes, and buy from and so it's the largest home builder in the United States. It's a very, very trusted, very, very resourceful company that isn't going to leave us in a bad spot.
Yep, and the rent is increasing. People have money to pay rents. So your numbers, investor, the rent to value ratio, the capitalization rate, cash on cash return, the rent to value ratio, what you just discussed, and the total return on investment, the numerical metrics, which I have calculated in your market, is really off the chart. I know my numerical formulas, a lot of people do not understand, but I have videos to talk about it. But trust me, I've done the research. The numerics, the numbers make sense even when the interest rate is 7.5, even 8%. Investors, listen, Justin, investors, smart investors, they don't buy an investment property based on interest rate. That's not the way it works.
No.
A primary homeowners, that's how it works, right? Primary owner-occupied buyers, they are limited by the higher interest rate with the mortgage payment because their paycheck can absorb so much of the payment. But our interest rate, the mortgages that investors get, our owners are not paying the mortgage. Who is paying the investor's mortgage, whether it's 6, 7, 8, or even 9%? Who is paying that mortgage? Come on, Justin, you answer.
It's the renter. It's the tenant. It's one of those trade-offs, right? I mean, when you're a tenant, right? The good side, right? You're not going to handle maintenance. You're not stuck somewhere for 30 years. You don't have to deal with trying to sell it when you want to leave. You have a lot of flexibility, a lot of mobility with where you live. On the flip side, if you think that an investor is losing money renting a home to you, you're mistaken. I mean, that's just the way renting works. So, it works well for our investors, but it does also give the freedom to our tenants to live in a way that they want. And it's been really, really good. We've been able to see a lot of success with these homes.
Yep. Well, Justin, you cover so many grounds, so much grounds. Everything is so thoughtful, so factual. It makes so much sense. It's common sense for any investors that couldn't see what we just discussed. I don't know. Are they really a true investor? I doubt that. So
yeah, I mean, it's again, we're looking at kind of try to keep it as basic as possible. Some people will look into a real estate market and they break out metrics that even I look at and I have to question what they're even talking about. And that's not, if I can't explain something on a very surface level and have it all make sense and just have a very basic thought process behind it, it's probably not right. But here with this market, I mean, it's really where we're at. I mean, we're trying to keep it as simple as possible. There's a lot of demand to live in this area. There's not a lot available to rent or buy, which means prices are projected to continue to rise. Rents are projected to continue to rise. And if you're someone who owns a home, that's music to your ears. That's perfect. So being that person who now owns a home in this market should be the next step for as many investors as it can possibly handle, really.
Well, Justin, is that your final thought? You have any one remaining final thought before we conclude this great presentation?
Yeah, no, I mean, like I said earlier, really, I mean, even if anything has remotely caught your interest from this video or any of the videos we've done or anything you've heard about this market, get in touch with Mr. Yee, talk about if it's right for you. And if it is, he's gonna get you in touch with me. We're gonna get you on the list. And we probably have about one home a week with some type of special. Take advantage while they're there. They're not going to be there forever. These are the first specials that I've seen in 6 to 9 months. So take advantage while they're there. I don't. One thing I think a lot of your investors will find, and they'll probably tell you the same. I take a very passive sales approach. I am not going to be that pushy salesman telling you buy, right? I'm going to lay the facts out. And if you make the decision to buy, I want to help you buy. but that's it. I'm not gonna push anyone to do something they don't want to do. With the prices the way they are, the specials that are there, I really hope investors are not going to pass on these opportunities, because I truthfully am very surprised that they're even there, and don't expect them to be there long. I mean, the last one that we did get, we very nearly missed. We got very lucky to even get that special. So again, take advantage of the opportunity, and it really is a good time to purchase a home here right now.
I totally agree with you, Justin. Wow, what a great, exciting moment. And investors out there, they have to just block off all the negative headlines. There's so much doom and gloom headlines out there, and you got to be smart about it. You got to find the right source, which is us and you, and do what's right for you, and create the urgency. Create the urgency, and pull the trigger and take action. Take action. That when it's all said and done, that's what it is. Do your research, find the right team, find the right market, and push forward, overcome all the fear and all the negativity, all the negative headlines out there, and take action, and your personal financial future will be awesome down the road. So with that said, thank you so much, Justin Zawodny, Southwest Florida Realtor Network consultant, and thank you for your time. We're looking forward to working with you for a long, long time to come. Thank you so much for your time and great presentation. To Seewing Yee. Have a nice day, everyone. Thank you for watching. Bye-bye.